Hey, it's Bill. We're talking about how to write A2 economics essays. Maybe you're in AS level. This still might be useful. This is the summer of 2018, question paper 41 and question 6a. Remember the general things. Read the question, make sure you understand the question, give them your definitions, do your application and analysis, and evaluate and make a conclusion. Let's see, which option is best? Which option is most effective, and good and bad parts of the different options? Who is affected? This is for evaluation. Who is affected? So let's say the firms, the customers, the banks, the lenders, the community, the economy. Which option is best, and anything else? Maybe there are other options. You don't need to talk about all of these in your evaluation and conclusion, but these are some of the things you can consider. So let's take a look at the question. It's here. And, well, I kind of translated this question here because I think, the way they write these, consider the extent to which the commercial banks can influence the money supply. And this is rather twisted. The extent to which, that's how much. Yes, I'm going back to writing on my screen again. How much can the commercial banks influence the money supply? Influence is change. Delta is change. So I'm just going to translate this question to how much can commercial banks change the money supply? Are they effective? Can they change the money supply very much? Maybe, maybe not. Let's see. So, you know the deal. What should we define here? We can define, commercial banks. And as you know, I usually start with a summary. Here's my conclusion and the summary. Because sometimes you can think of the answer to these questions in 1 second. You can answer it, but you must write it. So my answer: commercial banks have great potential to influence the money supply, but there are several limits. Maybe I shouldn't have written so quickly. They can increase, but probably not decrease the money supply. I think that's true. So, the money supply. What is that? What is the money supply? So there is narrow money, or define it: circulated notes and coins and balances held by commercial banks in the central bank, and broad money, which includes notes and coins and people's and firms' bank deposits instead, pardon my typos, instead of banks' deposits at the central bank. This definition of narrow money, that's the Cambridge definition. If you go on the internet and look for the definition of narrow and broad money, you might find many definitions, unfortunately. So just use the Cambridge definition. So now I must explain, so that's analysis. Commercial banks create money every time they loan funds. True. And deposit that amount in an account at another bank. That creates money. Credit, this is the credit multiplier. And of course, banks can loan much more than the deposits they keep. There's the multiplier effect. The reserve ratio is 10%. Banks can loan 90% of their deposits. That could at least double, almost double, the amount of currency or narrow money in the economy. For a bank, a loan is an asset they earn profits from, so the bank has every incentive to loan as much as possible. And that increases the money supply. So yes, banks can increase the money supply. But here's the other side of that. People and firms need a reason to borrow money. No one borrows money simply because it's available. Consumers borrow when they have a need, like a house or a car. And firms borrow when they can earn a higher return than the interest paid on the loan. Makes sense, right? If you have an investment and you think you can earn 10% and the loan is 5%, then maybe you borrow the money and make that investment. So a bank could lower their interest on loans, but demand for loans is likely inelastic, so they would simply earn less profit on more loans while increasing the money supply a little. This is kind of extra. I'm just thinking out loud. Other factors limit the bank's ability to loan all of its funds and earn abnormal profits. That would be nice. There are regulations that limit the amount of risk a bank may take when loaning money. Borrowers must qualify for a loan, either with demonstrable income or assets, or both. And of course, there's the reserve ratio, the required reserve ratio. The bank must keep a reserve of cash at the central bank to ensure solvency, the reserve ratio. And the central bank might reduce that required reserve, but that does not cause consumers and firms to borrow the additional available funds. That's analysis. So the banks can loan all their money out and increase the money supply, but people must borrow that money and they must have a reason to borrow that money, people and firms. So, if the supply of available funds increases, that will reduce the interest rate and increase the number of loans taken by consumers and firms. But I think that amount will have a negligible, misspelled negligible, effect on the broad money supply. So if banks refuse to lend, the money supply stays the same. Commercial banks cannot reduce the money supply like the central bank. So I think commercial banks have some, but a limited ability to increase the money supply. What do you think?